Hello everyone and welcome back to another fantastic episode. I hope you're doing well and looking forward to a fantastic learning experience. This is the 39th episode of a journey I began some time ago. I took a step and devised a new method of learning and having fun. My goal is to create a logistics company that will teach individuals how to establish businesses while also teaching them business and life skills. I'm pleased that the progress has been remarkable and that the overall experience has been positive. I'll be transporting wheat to Kiel today, and along the way, I'll explain what budgeting is and why it's crucial to have that knowledge. Don't forget to like and subscribe for more educative videos like this. Enjoy! What is a budget? A budget is an estimation of revenue and expenses over a specified future period of time, and is usually compiled and re-evaluated on a periodic basis. Budgets can be made for a person, a group of people, a business, a government, or just about anything else that makes and spends money. To manage your monthly expenses, prepare for life's unpredictable events, and be able to afford big-ticket items without going into debt, budgeting is important. Keeping track of how much you earn and spend doesn't have to be drudgery, doesn't require you to be good at math, and doesn't mean you can't buy the things you want. It just means that you'll know where your money goes, you'll have greater control over your finances. Budget development process. The process begins by establishing assumptions for the upcoming budget period. These assumptions are related to projected sales trends, cost trends, and the overall economic outlook of the market, industry, or sector. Specific factors affecting potential expenses are addressed and monitored. The budget is published in a packet that outlines the standards and procedures used to develop it, including the assumptions about the markets, key relationships with vendors that provide discounts, and explanations of how certain calculations were made. The sales budget is often the first to be developed, as subsequent expense budgets cannot be established without knowing future cash flows. Budgets are developed for all the different subsidiaries, divisions, and departments within an organization. For a manufacturer, a separate budget is often developed for direct materials, labor, and overhead. All budgets get rolled up into the master budget, which also includes budgeted financial statements, forecasts of cash inflows and outflows, and an overall financing plan. At a corporation, the top management reviews the budget and submits it for approval to the board of directors. Static versus flexible budgets. There are two major types of budgets: static budgets and flexible budgets. A static budget remains unchanged over the life of the budget. Regardless of changes that occur during the budgeting period, all accounts and figures originally calculated remain the same. A flexible budget has a relational value to certain variables. The dollar amounts listed on a flexible budget change based on sales levels, production levels, or other external economic factors. Both types of budgets are useful for management. A static budget evaluates the effectiveness of the original budgeting process, while a flexible budget provides deeper insight into business operations. Personal budgets. Individuals and families can have budgets too. Creating and using a budget is not just for those who need to closely monitor their cash flows from month to month because money is tight. Almost everyone, even people with large paychecks and plenty of money in the bank, can benefit from budgeting. The importance of budgeting cannot be understated. A budget, also known as cash flow, is arguably more important than the actual cash that you have in your bank and investment accounts. Your cash flow is what allows you to pay for everything or not. Without knowing your cash flow, you could be putting yourself into a bad financial situation and not even know it. You can only get by without knowing your cash flow for so long before you get into financial trouble, so make the time you know the flow of your cash. Budgeting should be something that everyone does, regardless of their financial situation. Budgeting is a wonderful tool for managing your finances, but many people think it's not for them. Here is a list of budget myths: the erroneous logic that stops people from keeping track of their finances and allocating money in the best way. 1. I don't need to budget. Having a handle on your monthly income and expenses allows you to make sure your hard-earned money is being put to its highest and best purpose. For those who enjoy an income that covers all bills with money left over, a budget can help maximize savings and investments. If one's monthly expenses typically consume the lion's share of net income, any budget should focus on identifying and classifying all the expenses that occurred during the month, quarter, and year. And for people whose cash flow is tight, it can be crucial for identifying expenses that could be reduced or cut, and minimizing any wasteful interest being paid on credit cards or other debt. 2. I'm not good at math. Thanks to budgeting software, you don't have to be good at math, you simply have to be able to follow instructions. Many of these programs are free and legitimate. If you know how to use spreadsheet software, you can make your own ledger. It's as simple as creating one column for your income, another column for your expenses, and then keeping a running tab on the difference between the two. 3. My job is secure. No one's job is truly safe. If you work for a corporation, being laid off due to downsizing or a takeover always is a possibility. If you work for a small company, it could die with its owner, be bought out, or just fold. You should always be prepared for a job loss by having at least 3 months' worth of living expenses in the bank. It's easier to accumulate this financial cushion if you know the amount you're bringing in and spending each month, which can be monitored with a budget. 4. Unemployment insurance will tide me over. Unemployment compensation is not a sure thing. Let's say a bad situation at work leaves you with no choice but to quit your job. Unless you can prove constructive discharge, that is, you were virtually forced to resign, your departure will be considered voluntary, making you ineligible for unemployment insurance. Besides, the benefits may fall well short of the wages you're used to. For most states, they average between $300 and $500 per week. 5. I don't want to deprive myself. Budgeting is not synonymous with spending as little money as possible or making yourself feel guilty about every purchase. The aim of budgeting is to make sure you're able to save a little each month, ideally at least 10% of your income, or at the very least, to make sure that you aren't spending more than you earn. Unless you're on a very tight budget, you should be able to buy baseball tickets and go out to eat. Tracking your expenses does not change the amount of money you have available to spend every month, it just tells you where that money is going. 6. I don't want anything big. If you don't have any major savings goals, buying a house, starting your own business, it's hard to drum up the motivation to stash away extra cash each month. However, your situation and your attitudes likely will change over time. Perhaps you don't want to save up for a house because you live in New York City and expect that renting will be the most affordable option for the rest of your life. But in 5 years, you might be sick of the Big Apple and decide to move to rural Vermont. Suddenly, buying a home becomes more affordable, and you might wish you had 5 years' worth of savings in the bank for a down payment. 7. I won't qualify for student financial aid. Yes, the catch-22 of student financial aid is that the more money you have, the less aid you'll be eligible for. That's enough to make anyone wonder if it isn't better to just spend it all and have no savings in order to qualify for the maximum amount of grants and loans. But that catch mainly applies to earned income. Whether you are an adult student going back to school or the parent of a student headed to college, the free application for Federal Student Aid (FAFSA) form used for Stafford loans, Perkins loans, or Pell grants does not require you to report the value of your primary residence if you own a home, or the value of your retirement accounts. Point 1. So if you want to save money without compromising your financial aid eligibility, you can do so by using your savings to buy a house, prepay your mortgage, or contribute more money to your retirement accounts. The savings you put into these assets can still be accessed if you face an emergency, but you won't be penalized for it. Even if you employ all the available legal strategies to maximize your financial aid eligibility, you still won't always qualify for as much aid as you need, so it's not a bad idea to have your own source of funds to make up for any shortfall. 8. I'm debt-free. Good for you. But being debt-free without any savings won't pay your bills in an emergency. A zero balance can quickly become a negative balance if you don't have a safety net. 9. I always get a raise or tax refund. It's never a good idea to count on unpredictable sources of income. This may be the year your company may not have enough money to give you a raise, or as much of a raise as you'd hoped for. The same is true of bonus money. Tax refunds are more reliable, but this depends in part on how good you are at calculating your own tax liability. Some people know how to figure how much they'll get in a refund, or how much they will owe, as well as how to adjust this figure through changes in payroll withholding throughout the year. However, changes in tax deductions, IRS regulations, or other life events can mean a nasty surprise on your tax return. 10. I just don't have the discipline. If you're still not convinced that budgeting is for you, here's a way to protect yourself from your own spending habits. Set up an automatic transfer from your checking account to a savings account you won't see, i.e., at a different bank, scheduled to happen right after you get paid. If you are saving for retirement, you may have the option of contributing a set amount regularly to a 401k or other retirement savings plan. This way, you can pay yourself first, have enough money for the transfer, and pay yourself the same predetermined amount that you know will help you meet your savings goals. In our next episode, I will explain how you can build a budget and ways you can budget when you are broke. I hope you've learned a thing or two about budgeting. We have finally arrived at our destination. Thanks for sticking with me until the end. My clients have paid me €3,889. That's a good amount. I will be uploading the next episode soon. Thanks for watching. Until next time, bye.